Good day, everyone. A big welcome to you all. We're delighted to have you all on this call, this webinar today. We truly appreciate you taking our time to be a part of this critical and absolutely essential webinar on IFRS 18, presentation and disclosure in financial statements, organized by Forbes Mazars in Nigeria. My name is Oluwatoyin Samuel, a senior associate of the technical service team here at Forbes Mazars in Nigeria. And I have the honor and the pleasure to serve as your moderator today and lead you through all the planned sessions we have. It is truly an exciting time for preparers of financial statements, and this is because IFRS 18 is a new accounting standard that is set to redefine presentation of financial statements across all entities. And in the words of Andreas Barkov, the chairman of the IASB, IFRS 18 is in fact the first significant update to presentation of financial performance in over 20 years. You must agree with me that this makes IFRS 18 such a big deal and justifies our gathering here today. Before we proceed, kindly invite your friends, your colleagues, let them know the IFRS 18 webinar has started. It promises to be an insightful session. To kick things off and set the tone of our conversation today, I have the honor to welcome to us Uwabia Ojike, the country leader of Forbes Mazars in Nigeria, and is also a member of the Africa Regional Committee, excuse me, for his opening remarks. Uwabia, we are delighted to have you here with us today.
Thanks, Toyin, and good morning, everyone, and welcome to the program. It's my pleasure to welcome you to today's webinar on IFRS 18, where we discuss its implementation, of course, with clarity and confidence. In my opinion, IFRS 18 represents one of the most significant shifts in financial reporting in recent years. Standard introduces a more structured, will I say, and disciplined approach to how organizations present financial performance. It comes with clearer definitions, sharper classifications, enhanced disclosures that will influence not just how results are communicated, but of course how users or stakeholders interpret them. And at Forbes Mazars, our view is pretty simple. Regulatory changes or changes like this should enhance the quality of financial information, not disrupt it. And our role as professional advisors is to help organizations navigate these transitions in a structured and forward-looking way. Today's session is designed to support the process. So I encourage you to engage actively and draw on the expertise of our team. At Forbes Mazars, we are one. We're an integrated partnership, which means we work as one team, and we have a stellar cast of speakers from Forbes Mazars in Nigeria and Forbes Mazars in South Africa. Carolina is on the call, Kashmir is on the call, Adams is on the call. So please engage in these discussions, and thank you very much for being here and enjoy the session. Thank you very much. Tony, I hand over to you.
Thank you very much, Uwabia, for that insightful opening. You have perfectly set the tone for what promises to be a very impactful session. Our theme today, as you rightly said, Uwabia, is a guide to implementing with clarity and confidence. And we're delighted to host here today finance leaders, accountants, auditors, CFOs, and every other professional that is committed to improving financial reporting and compliance. Our goal today is simple. We will provide clarity on the key requirements of IFRS 18 and also provide you with actionable insights for a smooth transition to IFRS 18. To deliver on this promise, you'll be hearing from all our distinguished IFRS experts who will help us decode IFRS 18. We will begin with an introductory session to IFRS 18. After that, we'll move to a more practical session speaking to the implementation bit of IFRS 18. And that is very important for those of us already planning for 2026 and 2027 reporting period. We will then transition into an interactive panel session, followed by the closing remarks by one of our panelists. Today's session promises to be insightful. And throughout the session, we encourage you all to participate actively, ask your questions using the Q&A feature on your screen. We have a team of experts ready to respond to your questions as they come. And during the panel session, of course, we would address some of your questions and also give you the opportunity to ask your questions live. With that being said, we will go right ahead to the agenda for today. I have the pleasure to welcome with us Kashmir Idekwelem for the first session on an introduction to IFRS 18. Kashmir is the head of the technical service team here at Forbes Mazars in Nigeria. He brings over 10 years of extensive professional experience in resolving high-level financial reporting consultations. He has facilitated several technical trainings in many top-tier banks and consultancy firms as well. He has facilitated several trainings. As I said, he's a key resource person on financial reporting and financial accounting issues to the Chartered Institute of Accountants here in Nigeria, that is ICANN, and the Chartered Institute of Taxation in Nigeria. It's a pleasure to have you here with us, Kashmir. For the next 25 minutes, Kashmir will walk us through the changes introduced by IFRS 18, the new income statement structure, and other changes introduced by IFRS 18 that affects other IFRS accounting standards and the financial statements. Okay, so before we go ahead with the first session, I would like to give the floor to Adams. So Adams, you had your hands raised.
Yeah, please, 1 second. I think some people said they cannot hear us. So I just want to be sure that they can hear. So please, if you can't hear, we'll type on the, in fact, let's do something. Can you just give us a thumbs up if you can hear? We want to be sure that you can hear. If you can hear, just give us a thumbs up. We want everybody to give thumbs up if you can hear us loud and clear. Thank you. Can we get more thumbs up if you can hear? Okay, great. So if you cannot hear us, we'll put the instruction. Okay, I think maybe external people. We'll do that now. Mercedes, please can just quickly double check that people from outside the organization can hear, and also put a call through to a few people. Okay, Samson Bello can hear, and it's from outside. So yes, so external people can hear. Maybe when you're connecting, just make sure that you activate the speaker. I think that's what some people have not done. So we'll do that. We'll drop some things in the chat and we'll help people. So thank you very much. Kashmir, you can go ahead.
Okay, thank you, Adams. Thank you, Oluwatoyin, and good day, everyone. Today, we'll be discussing a key topic, a guide to implementing IFRS 18 with clarity and confidence. Our discussion today will focus on the general overview of IFRS 18 and the key changes to financial statements as a result of IFRS 18. Let me start by saying that IFRS 18 is presentation and disclosure in financial statements, and it was issued in April 2024 to replace IS1, presentation of financial statements. Although IFRS 18 replaces IS1, but retains most of the core principles and requirements previously contained in IS1. Which entity should adopt IFRS 18? All entities, whether private or public, that prepares their financial statements in accordance with IFRS accounting standards must mandatorily apply IFRS 18. When should IFRS 18 be effectively adoptable? When should we start adopting IFRS 18? IFRS 18 is effective from the annual reporting period that begins on or after 1 January 2027. What that means is this, that the effective date actually depends on the reporting entity's reporting period. Let me make it clearer. For entities that their reporting period runs from January to December, the effective date becomes 1 January 2027. For entities that the reporting period runs from April to March, the effective date becomes 1 April 2027. For entities that the reporting period runs from October to September, the effective date becomes 1 October 2027. Meaning, in summary, the effective date is the beginning of the accounting period that commences in 2027. IFRS 18 also requires that the comparative period for it, precisely 2026 financial information, must be restated, meaning that restatement is mandatory, not optional. I would also like to emphasize the fact that IFRS 18 also permits earlier adoption, meaning that entities can choose to adopt IFRS 18 even before 2027. Now comes the big question. Why IFRS 18? The answer is straight. There was a problem with IS1. IFRS 18 brings the solution. Let me explain. Under IS1, there is significant level of inconsistency in how entities classify and present income and expenses in the statement of profit or loss. This inconsistency stems largely from the wide flexibility permitted by IS1 regarding selection and presentation of line items and subtotals in the statement of profit or loss. As a result of this, different entities adopt different reporting practices, which led to financial reporting diversity that made it very difficult for users of financial statements, especially investors, to effectively compare performance across entities. Now, IFRS 18 establishes a more consistent, well-structured, principle-based way of classifying income and expenses in the statement of profit or loss. This consistent and well-structured classification of income and expenses in the statement of profit or loss enhances comparability, transparency, and clarity of reporting performance, which makes it easier for users of financial statements, especially investors, to make informed decisions. Complete set of financial statements substantially remain the same as it was under IS1. But let me say that the financial statements is largely categorized into two: the primary financial statements and the notes to the financial statements. the notes to the financial statement remain as the name implies. The primary financial statement will include our statement of financial position, statement of profit or loss, and other comprehensive income, which IFRS 18 also permits that it can be combined or separated. Then the statement of changes in equity and statement of cash flows. Here comes the game changer. Categories of income and expenses. This is the main or one of the major benefits of IFRS 18. So I would like us to pay serious attention here. And I would likely do a bit of teaching here because this is key. The categorization and classification of income and expenses depends largely on the entity's main business activities, meaning that entities' main business activities determines how their income and expenses should be classified. IFRS 18 identifies 5 categories, which are operating categories, investing categories, financing categories, income taxes categories, and discontinued operation categories. What is more important to me is what type of income and expenses should be classified under each of these categories. Let me start by saying that under the operating categories, 2 major lines of income and expenses are key. They are: 1, all income and expenses relating to entities' main business activities must be classified under operating categories. 2, all income and expenses that cannot be clearly classified to investing categories or financing categories or income taxes categories or discontinued operation categories must be classified under operating categories. This last point was actually stated under paragraph 52 of IFRS 18, meaning any income and expenses that you are very sure it cannot be classified under investing, cannot be classified under financing, cannot be classified as income taxes, and cannot be classified as discontinued operation, must be classified under operating categories. In addition to this, let me also emphasize that all staff salaries and wages, irrespective of the entity's main business activity, must be classified under operating categories. And likewise, all non-recurring costs, one-off costs, should be classified under operating categories. Now, investing categories. Let me put it this way. Under investing categories, we are to classify income and expenses that relates to assets that can independently generate cash flow on their own, except if that happens to be the entity's main business activity. In a clearer form, it means that rental income on investment property should be classified under investing categories. Income and expenses on financial assets, cash and cash equivalents, should be classified under investing categories. Fair value gain and fair value losses on financial assets classified at fair value through profit or loss should be classified under investing categories. Depreciation and impairment on investment property measured using the cost model of IAS 40 should be classified under investing category. Transaction costs on financial assets classified at fair value through profit or loss should also be classified under the investing category. All returns on investments should be classified under investing categories. Now, some weeks ago, in a training with one of our clients that actually specializes in real estate, that happen to be their core business activities. When we address this, they all agree to the fact that their rental income, fair value gain, and fair value losses on some of their investment properties measured at fair value using fair value model should go to operating categories. Likewise, depreciation and impairment on some of their investment properties that are measured using the cost model must go to operating categories. This sounds contradicting to what I just said earlier, but not at all. This is simply because these very clients, their main business activity is in real estate. And that is why those items of income and expenses fall into operating categories and not investing categories. Moving to financing categories. Under IFRS 18, especially paragraph 59, for the purpose of financing categories, IFRS 18 identify two liabilities or classify liability into two. Liabilities arising from transactions that involve only the raising of finance, which for me substantially means liability arising from borrowings. The second liability is liabilities arising from transactions that do not involve only the raising of finance, which substantially mean liabilities other than borrowings. But to make it clearer, what this means is this: all income and expenses arising from borrowings should be classified under financing category. Fair value gain or fair value loss on financial liability classified at fair value through profit or loss should be classified under financing category. Where an entity applies the defined benefit plan of IAS 19 employees benefits, net interest costs on benefit obligation and net interest income on benefit assets should be classified under financing category. Lease interest expense from the lessee standpoint, calculated in line with IFRS 16, will be classified under financing category. Where we have long-term provisions arising from future dismantling costs, future restoration costs, calculated in line with IAS 37. It means that the increase in provision that we generally call unwinding costs, which in substance means interest costs, must also be classified under financing category. Having said this, there will be a little modification when it comes to entities that provide financing to customers. For income taxes category, these are basically tax income and tax expense calculated in line with IAS 12. While discontinued operation category remain income and expenses relating to an operation that has been discontinued or about to be discontinued, calculated in line with IFRS 5, non-current asset held for sales and discontinued operation. Now, for insurance businesses, because of their peculiarity, they invest largely on financial assets. It means that investment income will be classified under operating category because of the peculiarity of their business that happen to be their main business activities. Then for banks, also because of the peculiarity of their business, where the bank for banks, interest income will be classified as part of operating categories. Then under paragraph 55 of IFRS 18, it was also specified that for bank and other lending institutions, all interest income and expenses that relates to cash and cash equivalents, which relates to providing of finance to customers, should be classified under operating category. And if it does not relate to providing of finance to customers, it should be classified under investing category. For the bank and other entities that provide financing to customers can make use of accounting policy choice made available under paragraph 56. and classify all the interest income and all expenses that relates to financial assets, cash and cash equivalents, under operating categories. And if the bank, in attempt not to apply the accounting policy choice, but now encounter challenges in splitting this, then everything should be categorized under operating categories. Another key benefits is that IFRS 18 now identify key mandatory subtotals. We have 3 mandatory subtotals. One is operating profit or loss, meaning irrespective of the main business activity of an entity, we must present as a line item operating profit or loss. Another mandatory subtotal which does not apply to entities that provide finances to customers is profit or loss before financing and income taxes. Then the third is profit or loss for the period. This is the general formats in line with IFRS 18. Time permits, we discuss this later. This has to do with industry-specific adaptation, and the focus here is what constitutes main business activity of an entity. The format will apply to all, the general formats will apply to all entities, with exception to 2 entities identified by IFRS 18, which are entities that invest in assets, of which example is insurance company, and entities that provide finances to customers. Another key benefits, aggregation and disaggregation. According to IFRS 18, classification and aggregation of assets, liabilities, equity, income, expenses, and cash flows must be based on shared characteristics. IFRS 18 requires that all these items, any of them that share the same characteristics, should be classified, should be aggregated and classified as a single line item. And those that do not share the same characteristics should be disaggregated and separated and presented separately. In order to achieve the useful financial summary and better understanding of the disclosures in the notes, presentation of line items and disclosures of information in the notes must be based on the principles of aggregation and disaggregation. Key changes introduced by IFRS 18 to other standards. Like I mentioned earlier, IFRS 18 retained most of the information we have under IS 1, and some was moved to IS 8. And as a result of this amendment, IS 8 title has changed from accounting policies, accounting estimates, and errors to the basis of preparation of financial statements. We discuss this maybe in another webinar program. But more importantly, IFRS IS 7 has also been amended due to the improvement brought about by IFRS 18. Prior to now, preparing statement of cash flows using the indirect method, in fact, the auditors among us will agree with this. Different entities start the operating activities with different type of profits. Some start with operating profit, some start with profit after tax, some start with profit before tax, some start with profit before interest and tax. That is no more. Amended version of IS 7 amended due to IFRS 18 requires that all entity, irrespective of the main business activity of such entity, must start operating activities with operating profits. And likewise, all dividend paid and interest paid must be classified as an outflow under financing activities, while dividend received and interest received must be classified as an inflow under investing activities. No more optional treatment. Financial position, there is no material change. Other IFRS accounting standards, little modification, but we may not discuss that today. Another key change brought about is management-defined performance measures. And this is key. In fact, some of our clients over the last 2 years had a lot of issues accommodating the recognition of exchange losses in their profit or loss. This is an opportunity for you to express your true performance. But we discuss this later. But let's look at what we can say now under performance measures. Performance measure, let me put it this way, is a disclosure information. And IFRS 18 is very specific on this. This must be subtotals of income and expenses, meaning that this has nothing to do with financial position items. And this must also be subtotals that are not specifically presented in the profit or loss. Also, there must not be subtotals required by IFRS. And they must also not be subtotals commonly used in financial statements. And they are subtotals that entity uses in public communication outside financial statements, which may include communication via management commentary, press releases, or investors' presentation. But IFRS 18 emphasized that this does not include social media communication or posts. Because of our time, conclusively, let me remind you the key points. Every entity should classify expenses into the 5 major categories. All income and expenses that relates to the main line of business, main business activity should be categorized under operating categories. Income and expenses that relates to investment, financial assets, investment properties should be classified under investing categories, except if that forms the entity's main business activity, then it should be classified under operating categories. For financing categories, it remains income and expenses that relates to borrowings and other liabilities. Thank you for your time. And Tony, over to you.
Thank you very much, Kashmir, for that comprehensive overview of IFRS 18. Particularly, thank you for stressing the changes introduced by IFRS 18 in relation with the new categories and for highlighting the activities that should be reported under each category. It is important to know that IFRS 18 is not just a technical update or a template change to our income statement. It is a strategic shift aimed at improving transparency, comparability, clarity, and also consistency of financial information across all entities. Now that we have addressed the technical and theoretical bit of IFRS 18, we would then move on to the implementation session to learn how we can translate these changes into real-life application. We have with us here today an IFRS expert from Forbes Mazars in South Africa. She will be speaking with us over the next 20 minutes on IFRS 18 implementation roadmap. Kindly join me to welcome Carolina Martin. We are happy to have you here, Carolina.
Thank you so much for having me.
Did you say something?
Yes,
okay,
thank you so much for having me.
Yes, we're happy to have you here. Carolina Martin is the IFRS Director of the IFRS Advisory Team at Forbes Mazars in South Africa. She has an extensive knowledge in IFRS accounting standards, and she's also involved in providing technical guidance and training to in-house professional staff as well as clients. She has over 10 years of experience working with IFRS accounting standards framework. Once again, Carolina, we are delighted to have you here with us today. You have the floor.
Thank you so much. I'll just quickly put the slides up. There we go. And just a warm welcome to everyone joining us today. We're quite excited to be talking about IFRS 18, as well as now just to share some of client insights and practical challenges and insights that some of our clients have seen and that we have also have seen. So with that, I will just do a quick recap. So Kashmir, thank you so much for a great overview of what IFRS 18 is. These are just the key changes I want to highlight as part of my session discussion around where potential challenges and additional thought needs to go into regarding the implementation of IFRS 18. So as Kashmir pointed out, we do have now a new categorized statement of profit and loss, which is categorized into the operating, investing, financing, income tax, discontinued operation. What I wanted to note here is that we are all familiar with the cash flow statement also has operating, investing, financing, but I just want to highlight that it's not the same. So just to give an example, if we have a company who is in the business of maybe selling trucks as their main business activity, as Kashmir had pointed out, when they sell, those gains, losses will be recognized as operating income, for example, for a profit on that. But when we actually look at the cash flow statement, that wouldn't be operating, it would be investing, because in a sense of, more from an investing perspective, that's the thing, is we have to have a look at exactly the differences between what is the nuances between IFRS 18 and I7. And the board has actually acknowledged that there is actually a difference between the two, and that this is something that they haven't actually addressed as yet. So that is quite an interesting point. Just wanted to point that out. In the sense of the subtotal, yes, we do have two mandatory subtotals, which is our operating profit. Operating profit is the one that basically talks to the operations and what is the net number in terms of your main business activity or your specialized main business activity. Then the other one was profit before financing. So that is something that is mandatory as the stakeholders or your analysts, when they were actually putting the standard together, highlighted that this is actually something that they like or they request to have a look at. But the one thing that I also wanted to highlight is that these two are mandatory, but as a preparer of financial statements, you are able to have other subtotals. And those other subtotals will depend on the other type of main businesses as part of the whole entity. Usually we might see this in conglomerates. Conglomerates being entities that have more than one type of business activity. They might have retail, they might have investing in assets. So again, there is going to be a bit of judgment that's going to be put in, but when determining your main business activity, it is going to be a matter of fact over judgment when you actually determine, because we have to have a look at essentially what is our business, what are we trying to achieve, where is our shareholder value actually growing, or where is it actually coming from, our revenues. Then aggregation and disaggregation. So what I really do like about this is that the standard is now encouraging the no more line items that are named other or sundry. I'm not too sure, Kashmir will probably know as well, but that is kind of the driving factor. And I'm not too sure if there's a specific paragraph within IFRS 18, but that is the driving factor. And that all comes down to labeling. So labeling, if we have something that says other, there must be something better than other. So it's going to take a bit of time or consideration in terms of when we have other and sundry, what does this actually mean for us? Okay, and also just wanted to highlight, there were a few other consequential amendments, but the one that we want to highlight is just also the cash flow statement. And just to add on to what Kashmir was saying, it's now your starting point is now different, but also now because of differing main business activities, there could also be a differing in terms of on a reporting console level, where exactly if one entity is a specialized main business activity, their interest dividends might be classified as potentially differently, even though the two are not the same, but it's more trying to align with the statement of profit and loss and the cash flow. So for those specified main business activities relating to investing or financing to customers, there is a bit more guidance on that. Okay, so having a look at Kashmir has shown us already what it's going to look at, but let's start unpacking this. Okay, what does this actually mean for us or for new preparers? So as mentioned, what is going to be the driving force behind how we categorize our income and expenses will be the main operating business. If you are, and this is done at a reporting entity level. So if you have one company and this is all that you, sorry, I'm just seeing the post, his slides are not moving. Is that for everybody?
Hi, Carolina. Apologies for I think from my end. Can anyone hear Carolina?
No, I think she's
Carolina,
trying to
okay.
come back to the front.
Okay, apologies for the technical glitch. I can see some hands raised. We will take in live questions during the panel session. Kindly hold on to your questions. But in the meantime, I can see we've been dropping the questions. If you want an immediate response, you could just drop that on the chat box. Okay. While we wait for Carolina to rejoin the session on the implementation.
Hi there. Apologies.
Oh, okay.
Seems like my Teams
Okay.
had crashed. So I'm back. So I will just share the slides
Okay.
once more. Apologies for that. I don't know why that has happened. There we go. Something is now sharing. Should I go back to the previous slide? Just maybe get an idea from the participants.
Yes, I think you should revisit
All right.
because you were frozen for a few minutes.
Okay, perfect. Okay, so as I'll just start again. So thank you, Kashmir, for the update in terms of the changes and what IFRS 18, right on grass seat where everyone's on. Okay, wonderful. What IFRS 18 is. So in my section, I'm just going to focus on the key changes and where we will potentially, or where preparers and implementers will potentially have issues in terms of actually implementing the standard. So first of all is the new categorization. So I just wanted to highlight that the categorization in the statement of profit and loss and the cash flow statement is not the same. So the ISB has noted this and they haven't done anything yet to address the differences in terms of when looking at a main business activity. The second one I wanted to just highlight is, yes, we do have the 2 mandatory subtotals. That does not limit preparers from providing additional subtotals in order to assist in understanding what the main operations and of the businesses are. So that will most likely be the case for your conglomerates. So conglomerates are those entities that have more than one business activity. So they could have retail, they could have banking, they could have manufacturing. So for me, for those type of entities, there's going to be a lot of work that's going to come through, but it's going to be a very long statement of profit and loss. Aggregation and disaggregation, for personally, this is my favorite because it does provide us with enhanced guidance on when to eliminate those others and sundries. So I suppose for your auditors out there, it's always a question that's raised, what is in other, what is in sundry? So the current guidance now provides more guidance in determining what is actually relevant without eliminating the importance of material items. So that's a great add for me to the standard. MPNs, this is the brand new concept, as Kashmir had pointed out. It's very interesting in the sense of there will be work involved here, especially for your listed clients, your banks, etc., who actually do publish their KPI or their performance measures outside of the financial statements. A lot of thought and or how do I say, conversations have been sparked in terms of what we currently have. Is it actually enough? Does it actually meet MPMs? We need to educate our board in terms of if they go and communicate anything outside of the financial statements. Will that qualify? Will we need to disclose? So that is one of those things. That is quite important. And cash flow statement, as I've mentioned, the cash flow statement again, these are consequential amendments that have been brought in. And again, where you have more entities within a group, there's going to be a lot more work in terms of aligning everybody in terms of what the IFRS 18's new presentation principles will be. I just want to check, is everyone still okay seeing the slides change?
Yes, it's good. It's good.
Okay, wonderful.
You can proceed.
All right, thank you. So just again, this is what Kashmir has presented us. This is what our statement of profit and loss will look like. So we have, I've noted here by nature and function. So we're all familiar in IS1, we talk to an income statement by nature or by function. By function is usually you've got sales, cost of sales, gross profit, right? Nature is more by the specific expense of nature. Under IFRS 18, you can now do either or a combination of the two. So it's a very important one to look at, because where you have by function, there is additional disclosures that will have to come into the financial statements in regards of actually providing amortization, depreciation, etc. Right. What else is important that I wanted to highlight, again, we've spoken about the subtotals, is that look, we're having a very interesting discussion in South Africa, particularly with our insurers industry, where they do not believe that they are actually by function. The majority of the big four, and including us, we all agree that an insurer is actually should present their income statement by function, because if you look at their an insurer has a subtotal that is insurance service result. So it's not the same as a sales cost of sales, but it's akin to all operations related to your insurance would fall into that one subtotal. So there's quite a debate, some saying that it's by nature, the big four, and including us, we are by function. So I believe this has gone to the IFRIC, or it will be going to the IFRIC, just to try and clarify this, whether this is actually just a local view, or is this actually affecting more other jurisdictions across the world. Okay. So again, highlighting and stressing, there was going to be judgment involved in terms of your operating, investing, financing. However, when you're actually looking at investing and financing, it is quite, how to say, inverted commas, rule-based in terms of it's very clear and specific in terms of what is investing and financing. When we're looking at investing, one of the items that has also sparked a bit of debate is your share of profit of associates and joint ventures. This was also quite a debate when they were actually providing or putting the standard together, because a lot of analysts also have requested that this share of profit of associates or from equity accounted investments is always investing. However, I'll refer again to our insurance industry. Insurers invest a lot in assets. They might have equity accounted investments that relates to insurance liabilities. And under the new IFRS 18, it might be a problem in terms of the performance or trying to show what is actually, investing related to insurance, that it won't be actually part of operating. So what the ISB has done is there is a transition arrangement on transition that insurers or any entity that kind of meets the venture capital organization, which does include insurers, are able to reclassify their equity account or equity investment to fair value. So if it is fair value, then all those income and expenses related to that would then move up to the operating. So there is that concession at least. So that is something just to also look out for when you are doing transition. Okay. I have just checking in. I have just changed my slide. Is everyone able to see that?
Yes, we can see your slide.
Okay, wonderful. Thank you. Right, so this is a brand new concept, management defined performance measures. What's really great about this is that it is now linking key management performance back to IFRS accounting standards. As part of the disclosure around the MPMs is a reconciliation from what it is in terms of your KPI to back to your IFRS subtotals. That is why they are very, there is those requirements that in order to be qualified as an MPM, one will have a look exactly at what is the subtotals making up the MPM. As Kashmir mentioned, paragraph 118 of IFRS 18 does exclude some KPIs or ratios from being MPMs. So from this perspective, it's very important to reassess all your performance measures that your board, that is being communicated to investors, etc., whether they still qualify as an MPM. And if they don't, does the entity or organization actually have to re-look at what is being reported out there so that it can be still included in the financial statements, or is it something that's only communicated that is not an MPM? But so there's a bit of thought that goes into this. That's why I wanted just to highlight that. And also we are anticipating situations where it is so important to educate your investors and your board in terms of what these MPMs are, because companies don't want to be in a situation where certain KPIs are being communicated but not included in the financial statements because they are not MPMs, or they are communicated but they are an MPM, and then you might have a gap in your financials in terms of completeness of the disclosures around IFRS 18. So the stakeholder engagement and understanding is quite important in this aspect. And also, I think it's important that the time is taken to actually go through each and every performance measure to understand exactly whether it will actually meet that definition or not. And if it doesn't, what does that actually mean for the entity in terms of new KPIs? Is there something new from that perspective? So what does the transition timelines actually look like? Well, the standard was issued in 2024. 2025 is this year where a lot of people, or like us, for example, we have been studying the standard, we have been looking into the standard, trying to understand practical implications of the standard, and as well as reaching out to some clients to say, have you started looking at the standard? How will this impact you? And then we sit with the client, we say, okay, this is how we see the financial statement or IFRS 18 impact. Let's have a discussion around that. 2026 is, as Kashmir is saying, it is a standard that needs to be retrospectively applied, which means your comparators have to be updated. And then again, it's effective for go live 1 January for periods beginning 1 January 2027 retrospectively. What are the challenges here is IT systems. And I have sat with 2 clients locally who have very big groups. And it doesn't quite seem a complex standard in terms of because it relates to presentation. However, the more reporting entities are within a group, the more practical challenges that will arise. Some of the conversations were obviously, if you have a group with differing main business activities, say you have a bank and a property company, right? And on a consolidated level, assessment is going to have to be done in terms of whether actually we need to bring in those subtotals. Is it actually part of the consolidated main business activity or not? Indicators of that, we need to start looking at, okay, from a console perspective for the group, looking at segment reporting. Is it big for segments? Or is it not big? You'd have to have a look at the type of communications that are going out, because if it is concluded that the banking and the investment property is not material for the group, because remember, we apply the categorization to each reporting entity on its own. So every reporting entity will have its own main business activity. So if that is the case, that it mustn't be. So then when you stack up your consolidation, the reporting entity, say for the bank or for the investment entity, where they have classified their specific gains and losses that should actually be investing for your for the consolidated, is actually operating in those. So when you stack it up, you're going to have to do additional console journals to move it to the right category for your reporting entity and what your main business activity is. If it is not the case, or if they are part of that, then we're stacking up on the same like-by-like basis. And the bigger the group with different main business activities like conglomerates, the more man hours and the more consideration has to go in. One of the things that is very important is your IT systems. Are your IT systems actually geared to do these over and above console adjustments? Is our staff needs to be aware of this, and we need to start looking at, okay, this is our whole group. These are the entities. What are they actually doing? What is their main business purpose? And as we start stacking up, we start seeing differences. And what's also important to note, in most jurisdictions, a separate financial statement is required to be presented. In that case, then, you'd have to also look at what is the main purpose of the separates versus the group. That can also differ. So a lot of consideration needs to go into that. And as mentioned earlier, when you determine main business, it's not just an accounting policy in terms of choosing what it is. It is a matter of fact based on what that entity is actually doing. What are the main drivers of that revenue? Another item which was very interesting is when I discussed aggregation and disaggregation with a big hotel group, they were saying, you know what, the entities within our group are not actually allocating or labeling certain expenses, income and expenses, the same. It's very different across. So if you're imagining a big group and every entity has an other and a sundry, and it's this other has got this type of expenses and everyone has got something different, how are we going to stack it all up so that when we actually consolidating, we kind of aligned? So a suggestion would be to think of a group policy, perhaps, to say, okay, and pushing it down into every entity. You're not allowed to disclose any other. You have to use this labeling principle or process. So there are just some ideas, and the more a person actually starts thinking about how the person actually going to implement this, there is a lot to think about. If you have one entity, it will most likely not be as complex, but the bigger your groups, the more complex it will get. And the sooner one can start, the better. Just on the final slide, so talking about when we're preparing, finance teams need to be made aware of the changes so that they can start thinking about what the impact is going to be on our reporting. How are we going to We have to look at our IT systems. Can our IT systems handle? How are we going to group our chart of accounts so that things actually stack up according per reporting entity, to illustrate what the operations and the performance of the operating section is. Then I know in South Africa we have the Johannesburg Stock Exchange, which does a lot of financial statement reviews or proactive monitoring, and they are quite vocal in terms of new standards and when they do their results coming out. So this will be one focus area from our perspective, and also most likely from other jurisdictions, what regulators will be looking out for, especially from an MPM perspective, because some MPMs might be driven by regulatory, but will those actually still meet the definition? Because you need to, as Kashmir said, the MPM has to provide an overview of the main performance of the entity as a whole. Again, your processes and controls. So it's not only your IT systems, but how is the process and data actually being collected? Currently, obviously for reporting purposes, but now how is the impact of IFRS 18, and especially from the classification of income and expenses, how is that going to impact how we collect our data, our controls and processes, and what else do we need to put in place to make sure that per reporting entity, each reporting entity has allocated their income and expenses according to their main business activity. Again, very important. I mentioned it earlier in terms of your MPMs. You need to communicate and educate your board, your finance teams and investors. Because there is now focus with IFRS 18 in terms of the operating. So the operating segment is quite vital, and there's going to be understanding. So if, for example, we are a conglomerate and we are going to be having manufacturing, insurance, and banking, for example, are under operating, we'll need to explain to our board or to our finance teams and to investors what the new subtotals means, for example, and then highlight exactly this is now how our operating or our operations are reflected within the statement of a profit and loss. So have those conversations early so that before anything is being communicated out to investors or during the period of implementation, as well as when IFRS 18 is implemented, that things are not being communicated that is contrary to what IFRS 18 requires. So that's something to look at. And then again, I'll just stress again, having a look where you have a very big group, it's important to stress the effect on the financial statements and whether new KPIs are necessary, whether the old KPIs, your performance measures, actually do serve the purpose. So there's a lot of thought that needs to go into the implementation of IFRS 18. Overall, the sooner a person can start, the better, especially because 2026 is upon us, and that is the year where the comparatives need to be aligned for when IFRS 18 actually does come into effect. Systems and training, that's very important for your IT systems because these things take time. Before I was at Forvis Mazars, I was in the banking industry in South Africa, and systems take time, and the bigger your organization, the more red tape there is, and there's a lot of time. And then usually there's always very short deadlines in order to meet your reporting deadlines. So my final message is the sooner one starts looking at the impact, the better. And please do reach out any questions or this. It does seem like a very simple standard because it's presentation, but when you start actually looking at the nitty-gritty of it, it can become quite a big project on its own. Thank you.
Thank you very much, Carolina, for sharing such valuable insights, particularly on the IFRS 18 transition. I can see the virtual round of applause. Keep it coming. One major takeaway from this session is that we need to be prepared. We need to train our finance team. We need to ensure that our IT systems, our policies align with IFRS 18, and particularly for bigger companies, conglomerates, as you have mentioned, Carolina, we need to start evaluating the impact on our financial statements. Thank you once again, Carolina, for that overview on the transition.
You're welcome.
Thank you. And a big thank you to every participant here once again for staying with us thus far. We should have a quick poll. This is important because, as Carolina has mentioned, the sooner we start preparing, the better. In order for us to gauge your readiness for a transition, a smooth transition to IFRS 18, we have some quick polls, right? It should be coming up on your screen right about now. If you can see the question, kindly. Oh, okay, yeah, yes, we have it up on the screen now. Okay, kindly, we need you all to participate. We want to actually gauge your readiness for IFRS 18 transition. And more importantly, your responses will guide our conversation during the panel session and every other future knowledge sharing sessions we will be organizing. Okay, I can see some responses coming up. Thank you for engaging. We are over 400 on the webinar today. I have just 80 responses. Okay, I'll just give a minute for us to send in our responses. I really want us to hit 100 mark of responses at least. It is a poll, so you should, I got a question, can't see the question. It is a poll, it should appear on your screen. All right, we have over 100 responses. The question was, which area of IFRS 18 do you anticipate the most challenges? We had 6% go for redefining subtotals. We had 43% for the MPMs, the management defined performance measures. And of course, I was expecting this. We have 51% for systems and process alignment. And this is just to show that we are not here already. We are just getting ready. We need to have trainings with our team. We also need to check through our systems, our accounting systems, speak with the IT in your team to ensure that all chart of accounts are structured accordingly to fit into IFRS 18. All right, so the responses are still coming in. The main challenge here is still system process alignment. And thank you, Carolina. Carolina actually stressed on this part, which is why we need to start preparing now. All right, with the polls out of the way, we will then move on to the interactive part of the session today, which is the panel session. We have questions. We can see that questions have been dropping in time to time, and we have a team that has been responding to them. However, on the panel, we would give you the opportunity to have you take your live questions shortly. Joining me on the panel today, in addition to our earlier speakers, which are Kashmir and Carolina, we have Justin Combrick and Osamudiame Adams. Justin Combrick is a partner at Forbes Mazars in South Africa. She's in charge of the financial reporting advisory team, and she's also highly experienced with IFRS accounting standards. She has provided technical accounting support and ad hoc advice on complex accounting issues to many entities. She reviews financial statements, financial models for compliance, and provides training and advisory services. She's also active on numerous IFRS committees. We are delighted to have you here. Finally, joining us on the panel, we have Osamudiame Adams. Osamudiame Adams is a partner here at Forbes Mazars in Nigeria. He has over 20 years of experience in audits and assurance, with a dynamic background spanning across the financial services and manufacturing industries, as well as leading assurance projects across various locations in Africa, the United States of America, and the United Kingdom. He also plays a pivotal role in coordinating programs, facilitating learning initiatives, and conducting coaching sessions both within and outside Forbes Mazars. Ladies and gentlemen, please help me welcome our distinguished panelists. To start off our discussion on the panel session, I would want to ask particularly on the new structure of the statement of profit or loss, right? Kashmir had spoken about it. Also, Carolina did speak about it. Operating category is like the default bucket for income and expenses not classified under investing or financing categories. With that default treatment, it sounds very easy, sounds very simple, but for specific transactions like foreign exchange transactions, it can be a bit tricky. Kashmir, how does IFRS 18 require entities to classify exchange gains or losses in the new structure of statement of profit or loss? Kashmir, please, you have the floor.
Okay, thank you, Tony. I will be answering this question using two of our clients. None of these clients that we prepare financial statements for in line with IFRS. So one of them is a multinational company here in Nigeria, and they have receivables in foreign currency. They also have payables that is being settled in foreign currency, as well as foreign currency loan. Now, in line with IFRS 18, particularly under Appendix B, B65 to B68. IFRS 18 requires that foreign exchange differences should be classified under the respective category that the line item that created the foreign exchange difference was actually captured. For clarity's sake, let me put it this way, using this our client as a case study. The exchange difference that arose from the translation of the receivables that will be received in foreign currency will be classified under operating categories, since receivables arises from receipts from customers. Then the exchange differences that arises from the translation of the loan, foreign currency loan, that is loan that will be settled in foreign currency, the exchange difference will be classified under financing category. Now, the exchange difference that also arose from the translation of trade payables that will be settled in foreign currency will also be captured under operating category. Now, if there is, for instance, investment property measured at fair value in foreign currency, provided the entity main business is not to invest in properties, the exchange difference arising from the translation of such investment property measured at fair value in foreign currency will be classified under investing category. Now, coming back to the second client of ours that we normally prepare financial statement for in line with IFRS. These very clients, why I want to use this client as a case study. This client has foreign suppliers, and these foreign suppliers normally supply goods to these clients on credit. And what happened, why it's peculiar, is because this is usually settled after a longer period of time, meaning that the amount settled or amount payable by this our client to the foreign supplier always involve or contain financing components, in simple term interest, because of the length of time it takes to pay back the amount due. Now, it therefore implies that the amounts payable by these very clients to the foreign supplier consists of two things, two components. The trade payable arising from the purchase of inventory on credit, and the financing component, the interest element, arising from the fact that the money was not settled until after a longer period of time. Now, in order to calculate the exchange difference arising from this, IFRS 18 under Appendix B requires that this should be split. The element that relates to trade payables, the cost of the goods that we are standing, should be classified under operating category, while the element that relates to the financing component should be classified under financing category. IFRS 18 also emphasize if doing this, if splitting this into different categories will require the entity to incur undue costs and efforts, the entire exchange difference should be classified under operating categories. So that is the treatment of exchange difference. In summary, book it under the related category where the line item was captured. Thank you to him.
Thank you very much, Kashmir, for shedding more light, particularly to how to classify foreign exchange gains or losses. I'm sure we now know that it is dependent on the activity. We had earlier mentioned that there's a big challenge for conglomerates. Adams, how does IFRS 18 affect micro, small, and medium-sized enterprises and also startups? What challenge would they encounter, or how does it affect them generally?
So thank you very much, and just confirm that you can hear me.
Yes, I can hear you perfectly.
Okay, thank you. So for me, IFRS 18 is not just for the big boys, if I can use that line. So it's for everybody, and it's pervasive. So I like the way Carolina put it. She said, on the surface, you think it's just for reporting, but when you start interacting with it, all right? Sorry, Carolina, rather. When you start interacting with the standard, you'll see how complicated and how far-reaching it is. So my own interpretation for IFRS 18 for SME is, as long as you're reporting IFRS, even if the local standard setting body come up and say, okay, we have IFRS for SME and we have some coloration to it, it's still going to be effective and it's going to affect you. So all the things you hear on this call, like one, you need to quickly capacitate yourself to be ready for the IFRS 18 implementation is important. Two, all the conversation around your system, process, and control is very, very important. Then three, you also need to be mindful that because you're an SME today does not mean you wouldn't go bigger tomorrow. So the foundation for the standards is to remain the same. And any auditor that goes through your financial statement and gives an opinion, they would say that you've complied fully with IFRS. So if that statement will be made in your financial statement, then IFRS 18 is important. So some of the quick wins I would say for MSME and startup is you need to really understand the shift from IS1 to IFRS 18. Then you need to quickly start doing the mapping of all that impact on your own financial reporting. Then also make sure that there's board buy-in. So a lot of times you want to implement standard and the runners of the business, they don't even understand the importance of the implication. So I think when Carolina was talking about the transition, she talked about the early communication with the board and making sure that they are at par with the implication of IFRS 18. I think all of that would help you to be able to be at the front line of implementation. And finally, if you're an MSME, one of the things I want you to also know is going through this journey, sometimes you need people to support you. So attending webinars like this, reaching out to people in public managers and co would also help you to achieve all of this. So thank you very much, Tony. I'll yield back to you and I can take other questions later.
Thank you very much, Adams, for that response to particularly to small businesses and startups. And as you have stressed, IFRS 18 is not just for a certain group of companies, it is for everybody. And the earlier we start to prepare for it, the better. All right, moving on. I would like Adams, rather Kashmir. You have a question that was sent in here. Kashmir, can you explain how income and expenses arising from investment in associates and joint ventures should be classified and presented in the new statement of profit or loss? Kashmir, kindly give us a very concise response in 2 minutes. That will be
Thank
helpful.
you, Tony. Coincidentally, it was an area that we really, had a very serious discussion during one of our trainings, I think 2 weeks ago, 3 weeks ago, on IFRS 18. So under IFRS 18, particularly paragraph 55, income and expenses arising from investment in joint venture and associates will be classified under investing categories, provided that is not the entity's main business activity. Meaning the moment your main business activity is not to invest in associates and joint venture, all income and expenses must be classified under investing categories. But where your main business activity is to invest in associates and joint venture, all income and expenses will now be classified under operating categories. Please be careful here. Despite the fact that your main business activity is to invest in associate and joint venture, which by default requires you to classify all income and expenses under operating categories, IFRS 18, paragraph 55, emphasized that if the investment in associates and joint venture was accounted for using the equity method, then it can never be classified under operating category. It must be classified under investing category, meaning that for all entities, any investment in associates and joint venture that is accounted for using the equity method, it must be classified under investing categories. IFRS 18 permits you to also indicate or present a voluntary subtotal, maybe after showing your operating profit, you can now bring as a separate line item income and expense on investment in associate and joint venture, classified using the equity accounting method. Then you now bring the subtotal to actually reflect what the result is before considering other income and expenses from other investing activity items, investing category items. Thank you, Oluwatoyin.
Thank you very much, Kashmir, for that response. We have a question from the Q&A box that I'll just address shortly. Okay, Carolina, how does the change from IAS 1 to IFRS 18 affect the banking industry in terms of preparation of financial statements, whether positively or negatively? How does this impact the banking sector?
So I would say it would depend. Basically, the subtotals that currently banks have would most likely be the same in terms of being presented, because banking is a specialized main business activity as defined by IFRS 18, and that is in sense of investing in assets as well as financing, providing advances to clients. So what is the main operations in terms of a bank? It's basically your net interest, net fee income, etc. So from a presentation perspective, I'm not seeing perhaps that it would be more of a major impact because of the specialized. However, knowing banks have very big groups again, and I think it's going to be a case of actually assessing every entity within the group, whether they have the same specialized main business activity that is being consolidated up. Most likely probably will be. So it's going to be more an exercise to make sure that what is happening with the bank is in line with IFRS 18. And when auditors do come to have a look at the financials and to see how everything is being done, that it is justified in terms of from a presentation. I am personally, I don't think it would be as a major impact. Possibly looking into that, like Kashmir was saying, additional subtotals. But if there are investments, and to Kashmir's point now, that are equity accounted, that would most likely have to be presented as investing, unless there are any investments in associates or anything that are classified at fair value, then that could be either or. It's just thinking what else it would be. It's going to be the exercise of actually going through the standards and all the key changes to make sure that it is aligned. Again, it's going to be from a group situation again, but when you have disaggregation and aggregation, it's going to have to go look down, okay, what do we have other and sundry, and where do we disaggregate further, or what do we aggregate across that would actually provide more transparent information from a banking perspective without obscuring material items. And knowing banks also actually, just thinking about it, your MPMs, your management defined, could potentially be a big area that would be impacted depending on your jurisdiction. So definitely, because that is something banks are constantly reporting from a regulatory as well as a performance or a banking perspective. So that I would see as an impact from an IFRS 18 perspective more. And again, it's going to come down to what everyone has to do is to educate and to have a look at and explain what the key changes are actually going to be and make sure that everyone is aligned.
Great. Thank you very much, Carolina. I have some other questions here. I will just address it to you, Carolina. It appears that IFRS 18 aids comparability of financial information within the same sectors, but not across different sectors. Can you provide clarity to this? Is it a particular sector that, yeah?
Yes, I think that's a very good question, because it's something that I have wondered about, because one of the main themes of IFRS 18 is to provide comparability. I do not see how it will be comparable in a sense of different sectors. And I think with time, this will definitely stabilize, or basically more comparability will come with time. Banking, investment. So as people start implementing IFRS 18, we will start seeing exactly what different sectors are doing. And most likely over time, especially being audited, it will most likely stabilize. So agreed, within sectors, we are expecting comparability, but because it is an entity or like for the segment of changes in or profit and loss, apologies, different main business activities or different reporting entities across sectors won't necessarily be the same. So it's going to be very difficult to actually compare apples with apples. So yeah, I think with time we will see how it pans out. Still, I think from a reporting entity or individual perspective, I think it's great in terms of the drive and the focus on what actually drives the operations of that particular entity. So that's the positive. But in terms of comparability across different sectors, I don't believe we will achieve that. But within a sector, with time, I do believe it will become more comparable.
Thank you very much, Carolina. I completely align with your line of thoughts, given the fact that the activities to be classified under the new categories is largely dependent on the main business activities of each company.
Correct.
I'll take some other questions. We have a lot of questions here from our participants. Kashmir, for non-banking financial services providers, such as PFAs, asset management companies, in what area could they be impacted by IFRS 18?
Okay, thank you, Tony. So such entities will fall into the category of entities with a specified like main business activity, because largely they invest in assets. So they are also affected because their income and expenses classification must align with the categories recommended by IFRS 18. Now, the income and expenses from their investments, maybe investment in real estate, investment in financial assets, will be classified under operating category because they likely invest in such assets. While every other classification remains as it is under general classification. Yeah. Most of them don't provide finances to customers, so as a result, there will be no adjustment with respect to income and expenses relating to borrowings and other liabilities. Thank you, Latwin.
Thank you, Kashmir. There were some hands raised earlier for questions. You have the time for your live question. Okay, I can see Smart. Smart, kindly unmute your mic and proceed to ask your question.
I don't think Smart is able to unmute.
Okay, hold on. Let me try to do that from my end. Smart, are you with us? Are you able to?
We've allowed the mic for Smart now, so I think you should just unmute from the side and speak.
Okay.
Yeah, thank you. So my question is basically around different countries' jurisdiction. I understand that different countries or different jurisdiction have their own local regulatory expectations, right? Now, my question is, could this lead to different perspective on classifications on the new IFRS 18? Because I know IFRS 18 has new classifications. Now, different countries have their and different countries operating under IFRS 18 might have their own expectations on these classifications. So I'm looking at the consistency across for multinational companies regarding this expectation by different jurisdiction. How does the new standard, or how are we ensuring that there's consistency irrespective of or knowing fully well that different jurisdiction might have their own perspective on classifications?
I'm happy to start or take this question. Smart, it's a very good question. And just from my experience from South Africa, the thing is, IFRS 18 has the paragraphs and the principles that are embedded within IFRS 18. So the outcomes should be the same. And it shouldn't be very different interpretations. Where I do see regulators maybe like influencing here is maybe providing guidance. From our perspective, there was locally a question raised in terms of IFRS 8, but obviously locally the audit firms and the regulator were not in agreement, so that went straight to the IFRIC where clarification was given. So my understanding and perspective is that regulators should not be providing a different view other than what the ISB and IFRIC has been provided. And it's a very good question because the way that the more we are actually looking into IFRS 18, there's different ways of actually seeing and interpreting. And this is where each country will have access to, or like the audit, I know with the audit firms, we have access to the large firms, and then we would discuss it amongst ourselves, and then we would then see whether we need to take this to the board to avoid situations where there is a difference of interpretation in terms of what the standard is. So again, it's a very good question because we are going to see more and more of these. So in country, it's going to be items that will be raised through the audit firms that would eventually, if need clarification, would actually come from that area in terms of auditors and then direct line to the ISB and that. But my view is that regulators should be providing more of a guidance role, or but not actually enforcing something that is maybe not consistent with other firms or other jurisdictions, for example. I don't know, Kashmir, if you want to have anything to add to that.
Kashmir,
Yeah,
would you like to add to that?
What is it?
Would you like to add to the points Carolina
I did not
raised
really
regarding the different?
I did not really hear Caroline, so I wouldn't know what I may have needed to add to what she said.
Problem.
But if you heard that clearly, then there won't be any need for that. So I won't end up repeating what she has said.
Okay, no problem.
I did not hear her clearly. Okay, or if I may chip something, I may just want to put it in this way. In every country where IFRS is fully adopted,
Sorry, I think Kashmir's network, right?
Yes. The network
fine.
is
So I think we can just move
it's
to the
back
next
from my
question.
end as well. Okay, we just take another live question. Ibrahim from Ibrahim. Kindly unmute your mic and go ahead
providing
to ask your
financing to
question.
customers operates within the same
Kashmir, if you're sick, can you confirm you can hear me?
Ibrahim can unmute now. We've allowed his mic.
Okay, all right, that's fine.
Okay. I think Kashmir is still presenting.
Yes,
we
apologies
can't
to
hear
that.
him.
It is the network.
And the question is actually for Kashmir.
Kashmir, kindly unmute. Yeah, okay. Go ahead, please, Ibrahim.
All right, thank you. So the question is for Kashmir. You mentioned early adoption and of course retrospective restatement. So I want him to throw more light on the retrospective restatement of the income statement and the way and manner in which it has to align with the standard. So what I'm asking is, a very snapshot of the movement from IAS 1 to IFRS 18. I hope this question is clear.
Thank you, Ibrahim, for that question. Kashmir, over to you.
Hi, you can hear me?
Yes, I can hear you. It's better now.
Okay. Honestly, I did not hear the question of from the last speaker. Can you take it again?
Okay, it was asking a question relating to the retrospective preparation for IFRS 18. How do you transition from IAS 1 to IFRS 18?
Okay.
Given that it's kicking off 2027, but we need to have a comparative retrospective statement for 2026.
Okay, so picking from what I think you must have said, has to do with retrospective adjustments with respect to 2026 financial figures, right?
Yes, correct.
Okay, very good. Now, for entities that choose not to apply early adoption of IFRS 18, it means that 2026 financial statements would have been prepared or will be prepared in line with IAS 1. In 2027, when they now adopt IFRS 18, all requirement of IFRS
Apologies for that technical glitch. The network is
Yeah, I think Carolina can actually address the question.
difficult. Okay.
Carolina can address the question while we are waiting for
Yes,
Kashmir.
I'll try to address. So if an entity, as far as I understand, if you're early adopting, you still need to do a retrospective application or adoption if you are starting early adopting. I would personally recommend people not early adopting just because of the amount of time, but also consideration in terms of your systems and everything. That needs to be taken into account. It's rather better just to take the time available until it is effective to do a proper and a good analysis in terms of implementation. However, if you are an entity that is actually very simple and then there's nothing wrong in early adopting. It all depends on facts and circumstances of the particular entity, what information is available, etc., etc. But as far as I understand, if you early adopt, you will also need to do a retrospective application. If I heard the question correctly.
Yes, thank you very much,
Yes.
Carolina. Sorry, quick one. I understand. My question is on the comparative figure. Early adoption 2027, comparative figure 2026. Will tally with IAS 1, 2027, IFRS 18. So how do we manage this? I think maybe you should speak to that. Did you get my question?
Yes, I think I understand the question. So basically we would do the same. So if we were doing it at the normal implementation, we would still be applying the same principles in terms of application. So instead of if we are early adopting, we are basically moving the years forward, and we would then have to apply the principles as if we have adopted IFRS 18. I'm not sure if I'm understanding the question. So it would be the same. So if we were doing it on effective, you would then do it from IAS 1, you would do the retrospective application. But if we are early adopting, we are just moving it a period forward, we would still do the same in terms of applying the same principles. Yeah, I hope that answers the question.
Yes, absolutely. Thank you very much.
Okay. All right, you're welcome.
Thank you, Carolina, and thank you, Ibrahim, for that question. we would just take one final live question from Catherine. Catherine, you should have access to unmute your mic right about now. Can you unmute your mic and take your question briefly? Catherine, can you hear me? I cannot hear Catherine. Am I the only one?
No, it's very faint.
Okay. All right.
Can you hear me now?
Oh, okay. Much
Yes,
better. Much
perfect.
better.
Thank you.
Okay, thank you
Please
so
go
much
ahead.
for this opportunity. My question is, how does the IFRS 18 affect religious organization? Keeping in mind that their main source of income is donations and grants and support. So how is this new IFRS supposed to impact on the financial statement and processes of the religious organization? Thank you.
All right.
Kashmir,
are you able to respond?
Well, Carolina, if you want to give it a start, then I can also chip in.
Okay.
No
That's
problem.
fine.
So it would be the same in the sense of, again, defining what your main business activity is. So for the religious organization, what is the main business activity? It is going to be obtaining donations, etc. So all your income and expenses would then be just presented under your operating. Anything that is not related to the donations, or basically, like Kashmir explained, you have investing that is providing returns outside of your operating, it would follow the same principles. So that's why it's very important just to define and understand exactly what the principles are. But this is again provided that the religious organization is applying full IFRS, and then they would apply IFRS 18 the same way as any other entity would do, is my understanding.
Yeah, thanks, Carolina. And I think just to provide more context, you have the not-for-profit and you have all of those fund donor organization. So from a management accounting standpoint, most of the time there's already like a predefined way of reporting, which is going to align with the donor or the deed or the trust. But once you say you're reporting IFRS, then definitely the IFRS 18 now becomes applicable. So we also see currently, even in Nigeria, where some donor organizations or some non-for-profit organizations have a different way of reporting, but that's management accounting, right? But when it comes to the financial reporting for the purpose of regulatory or statutory usage, and we're talking IFRS, then this becomes applicable. Then what Carolina mentioned with regards to what exactly is the primary business activity, that will now drive the way you go about the whole implementation. And for the whole retrospective application or implementation of IFRS 18, if you're on the call and you were probably doing accounting in 2010, 11, 12 in Nigeria, we moved from NGAAP to IFRS. So the whole IFRS 1. So we expect a bit of all those kind of reconciliations, right, to happen for IFRS 18 also, where you see the IS1 implication, then the IFRS 18 implication, the reconciliation, and all those notes to explain them. So just trying to piggyback on what Karina said for the question before this one. So that's just the perspective. And one thing we're also doing within Forbes Masters is, as we engage with our clients and also see a lot of all these questions come up, we're also helping people with the whole technical process of transiting from the IS1 to IFRS 18, the end-to-end, helping to do the transition. So I hope that helps a bit both for Abbas and Catherine. Thank you.
Just to add, IFRS 18 is not changing the measurement in terms of the income expenses or the underlying assets. It's focused on the presentation and how we are presenting our information, similar to what IS1 has always done. It's just an update on that. So agreed. If it is another form of accounting and it's not in compliance or specifically IFRS, then that other form of accounting would take precedent. But if you have to or are complied and you are doing IFRS, then you would just follow the same principles. Thank you for clarifying, Adams.
Thank you, Adams and Carolina. We can no longer take in more questions. We can see a lot of the questions on the Q&A box, but what we're going to do from our end is that we will collate all of these, your questions, provide responses to them, and also share with you just to enable you get clarity and get answers. Thank you all once again. Thank you. A big thank you to our distinguished panelists from Forbes Mazars in Nigeria, as well as Forbes Mazars in South Africa. Carolina, it was truly an honor to have you here with us. You must agree with me that this has been very insightful and very clarifying, most especially in regards to the transition to IFRS 18. We can see clearly that we have a whole lot of preparation to do, from training to system requirements. I would now hand over to Osamudiame Adams for our closing remarks. Adams, please, you have the floor.
So thank you very much. Just also, we know Kashmir had to come into my office because of his technical glitch. So it's good to have Carolina, Kashmir, Oluwatoyin,
Yes,
and the whole team at the back end work on this. And I'll say a very small African proverb. So if you start sharpening your iron or your knife on the day of battle, then you've probably lost the battle. So what this means is IFRS 18 is not what you need to wait until 2027. You now say you want to start implementing. The reality is a lot of the heavy lifting should have been done before 2027. So that's why we are coming at you. And thanks for sharing your time with us this morning to explain to you high level the implication of IFRS 18, talk about the transitioning, and also make you understand the things that you need to quickly invest in so that you're ready for implementation. The reality is, if you don't start on time, and if you don't make sure that your processes, your system, your controls, and even your people are well capacitated to implement the IFRS 18, then you get to a point where the alarm bells will go off. You end up probably implementing wrongly, and you report the wrong financial statement. And don't forget, similar to South Africa, also in Nigeria, regulators are becoming much more active. They're they're becoming more aggressive. Whatever it is that you report, you see a lot of review, queries, sanctioning, and the cost of non-compliance is always much more expensive than complying. So we really want to thank every one of you for sharing your morning with us. And we also want to confirm to you that as Forbes Mazars, the IFRS technical team across Africa, Nigeria, South Africa, any other place you are located or situated, we are willing and ready to support you and hold you through this process. We've invested quite significantly into capacitating our people, even helping people already with early adoption for implementation. And we really strongly recommend that you jump on this bandwagon of early adopters so that you can take the lessons upfront. And at the back end, when it's time to go live, you've already addressed all the issues. So on that note, I would say thank you very much on behalf of the partners and management of Forbes Mazars across Africa. And much more, a very big thank you also to Carolina, Kashmir, Oluwatoyin, the entire AOS and AOS and technical accounting team. Thank you very much and have a good morning.
Thank you very much, Adams. And a big thank you to all our participants on this call. You have truly made this an impactful session through your engagement. I know that it has been value for your time. And as a lot of you has been asking, the presentation slides will indeed be shared across, as well as every other additional IFRS 18 resources that is needed. My name is Oluwatoyin once again, and it has been an absolute pleasure moderating today's webinar. I wish you all a successful transition to IFRS 18. Do have a wonderful day.